Hello guys, and welcome to the Startup College Business Data Analytics course. We've been looking at the analysis of financial statements through data analytics, and today in particular, we shall be looking at common size financial statements. Now, what are common size financial statements? Common size financial statements are types of financial statement presentation that display each line item as a percentage of a common base amount. The common base used for the income statement is usually total revenue, while for the balance sheet, it is typically total asset. This presentation format allows for better analysis and comparison of financial data, as it standardizes the figures and makes it easier to identify trends and patterns. So what we are saying, when you look at an income statement, you have the values for total revenues, you have the cost of goods sold, you have the gross profit, you have the expenses, all the way down until you arrive at the net income or the net profit. Now, what the common size financial statement does is that you express each of these line items as a percentage of a predetermined figure. And in an income statement, it is usually the revenue. So you will be expressing the gross profit as a percentage of revenue. Now, this is important because you might be analyzing, or you might be, let's say, comparing the performance of two companies that are of different sizes. If you use absolute figures only, such as revenue, you might be misguided, or such as net profit. Let's say, for instance, company A earns revenues of 1 billion shillings and profit is 1 million, while company B is generating revenues of 10 million, whereas the profits are also 1 million. From the face of it, using absolute figures, you might suggest that both companies are performing equally, since absolute figure for profit is the same at 1 million. But when you look in, or when you investigate further, this company that is generating revenues of 10 million shillings, whereas revenue is net profit is 1 million, has a higher profit margin than this company A that has 1 billion in revenues and 1 million in net profit. So it is a common size financial statement that will help you discover this. When you express now the net income as a percentage of revenue, you'll get to see which company is performing better. Also, this common size financial statement can be used to investigate the proportion of each, let's say, expense to revenue. You might find out that maybe you're paying too much rent in comparison to revenue, and therefore you might investigate why that is the case. Maybe you will need to downgrade to a smaller premises or a less expensive premises. So a common size financial income statement, each revenue and expense item is shown as a percentage of the total revenue. So this will allow the analyst to review them and come up with conclusion. Let us look at a sample. Here we have a sample or figures from an income statement. We have revenues, we have cost of goods sold, we have gross profit, we have operating expenses and net income. And on the far right, you can see that they have been expressed as a percentage. So revenue remains as 100%. Cost of goods is calculated as 900 divided by 1.5 million, you get 60. For gross profit, you get 40%. For operating expenses, you get 23.3%. For net income, you get 16.7%. Right? So let us look at a sample. Here we have a sample question that we are going to use to do this practically. So the question reads, you are provided with the following profit and loss statement for Little Bird Company. So here we have the sales and all that, the profit and the net, the profit after tax, the income tax, and so on. So required, generate a common size income statement. Number 2, generate 5-year forecasted income statement using the following assumptions. Revenue will grow at a constant 12%. The company intends to pay off its debts progressively, and thus interest expense will decline at 5% year on year. C. Income tax rate remains constant at 30%. D. the company intends to maintain the common size of all the other elements. So the first step is to copy down the profit and loss account into Excel. So we just highlight, Control C, open up Excel, then hit Control V, and then you can readjust the width of these columns by hitting Alt O C A, and they auto resize themselves. Then we can format this to be a more accounting figure by hitting on comma and then removing the brackets, removing the decimal points. So here the skill that we are going to use is referencing. You're supposed to express each of these elements as a percentage of sales revenue. So we are going to use referencing, and the type of referencing that we are going to use is absolute referencing. If you're not familiar with this, you need to check out our class on referencing. Just there above, scroll on to the curriculum and you're going to see the class on referencing, and you'll get to see what is absolute and relative referencing. So since you're expressing all of these elements as a percentage of sales revenue, it means that the sales revenue will be our denominator. So here on cell C3, we are going to write common size. And then here we are going to type in the formula, that B4 over B4, and then since the denominator is the one that is remaining constant, we make it into an absolute reference so that we can copy down the formula. Hit F4 and it becomes absolute. Hit enter. So it becomes 1. We can format it to be percentage, maybe 2 decimal points for accuracy. Once we have that, we can drag it all the way down until profit. So we can see that the profit margin is 6%, right? It's better we include the top borders here for the sake of neatness. Here. So we get that, right? Here we can see that we have our common size income statement. This is what we call a common size income statement. All of the elements have been expressed as a percentage of the sales revenue. So we have satisfied part A. Part B, or number 2, requires us to generate a 5-year forecasted income statement using the following assumptions. So one of the benefits of an income statement, of a common size financial statement, is that it makes it easier to forecast, to perform a forecast, since we have been told that all the elements will retain its common size, right? So what do? We need to copy this down here, the elements, hit Control C, hit Control V, and then we can type down here 2023 for ease. So this is just a number, does not have 2023, and then we can copy down these elements. Control C, copy them down here again, and then for 2024, let us generate the forecasts. So we can write 2024, 2025. We are told to make a forecast of how many years? 5 years. So it's gonna be from 2024 to 2028, 5 years. So 2023 is our current year, so the forecast will be 5 years. We can drag it and we have the 5 years. And then for sales revenue, we just use the assumptions that have been given. Revenue will grow at a constant 12%. So here we can write down assumption, revenue growth 12%. Now to get the revenue for 2024, we simply say, we write the formula equals B17, which has our sales revenue, multiplied by 1 plus 12%, or plus this figure here, 12%. Remember, you need it as an absolute reference. So we hit F4 because we are going to drag the formula all the way to 2023. Hit tab, and we have our figure for 2024. Now for 2025 to 2028, we just autofill this. We just come to the bottom right corner and drag it all the way to 2028, and we shall have the revenue figures all the way to 2028. Now to calculate the gross profit or the cost of goods sold, we are told that it's going to maintain the same. So the common size was at 70%. So we expect it to remain at 70%. So we write equals, we can write 70%. And then since this is remaining constant, we use absolute referencing, hit F4, multiplied by the revenue, sales revenue for 2024. Then we hit tab, right? Then we can drag this all the way to 2024. And the reason why we are seeing these pound signs is because the width of the columns is too small for the number. So we auto adjust it by hitting Alt O C A, right? We can do that, or we can just come here and hit double click on that. Come here, double click on it, double click on the column width, double click and double click. So we have our cost of goods sold. Now for gross profit is sales revenue minus cost of goods sold. So here plus, since it's already negative. And then we can drag this formula all the way to 2023. Now to make it neat, we introduce top border like that. So we have our gross profit all the way to 2028. Then we are told that we have now the operating expenses. Now operating expenses were at 15%. So say equals this 15%, make it absolute, multiply by the revenue. Hit tab. Then we can drag this to 2028. So we have all that operating expenses. Now to get the net operating income, we get the gross profit minus the operating income. Then we drag this to 2028. Add a top border. Depreciation was at 5%. So 5% absolute multiplied by the revenue. Hit tab and then drag to 2028. Interest expense. Now for interest expense, we are told the company intends to pay off its debts progressively, and thus interest expense will decline at 5% year on year. 5%. So here we can write interest expense decline. We are told it's 5%. So to get that, we say equals this figure multiplied by 1 minus this 5%. And remember to use absolute referencing, close brackets, hit tab. Then we can drag this all the way to 2028 since the decrease remains constant. What is the profit before tax? Profit before tax now is going to be the sum of this net operating income, depreciation, and interest. We are saying sum because the expenses have been expressed as negative. We have the profit before tax, and then we drag it, and then we can introduce top border for neatness. Now, when it comes to income tax, we've been told the income tax rate remains constant at 30%. Means constant at 30%. So we can write here income tax rate 30%. So what is the income expense? Equals profit before tax multiplied by multiply by 30%, and then absolute. Remember to express it as a negative, so include a negative sign before the formula, then hit tab. Then here we can format painter for it to be in the same format, right? Then we can drag this to 2028. We can add decimal points, 2 decimal points for accuracy. So we have these figures of income tax expense all the way until 2028. Now to get the profit after tax is profit before tax minus the tax expense. Drag it to 2028 and then include a top border. So voila, there we have our our profit and loss account forecast from 2024 to 2028. It is as simple as that. So try it yourself, try and see whether you can do it yourself. And in case you have any question, do not hesitate to ask. Until next time, see you.